Okay, let's unpack this. This deep dive, it's a really fascinating mix. We've got personal struggle, tough business realities, and some pretty complex financial rules all tangled together.
Yeah, it really gets into that difficult, often painful process of dealing with financial setbacks.
Yeah.
Whether it's a big investment that didn't work out or a whole business venture going south.
Exactly. We're looking at the human side, taking that financial hit, how it connects with the bigger business picture.
And importantly, how the systems we have for handling money, like the tax code,
Yeah.
actually play into it.
Right. And we've got a really compelling stack of sources to guide us today. We're pulling from the trenches, like this really candid Reddit thread from someone who actually lived through a failed restaurant.
Mm.
Then there's the big picture view from an Acumen report on venture philanthropy and failure, which is quite revealing.
Yeah, that one's interesting.
We're also looking at the personal toll with guidance from helpguide.org on coping with financial stress. And then the technical stuff, IRS instructions on capital gains and losses, some insights on tax loss harvesting from Charles Schwab.
In industry specifics too, right?
Yeah.
On restaurant due diligence and failure rates from Menu Tiger and Aaron Allen and Associates.
Exactly. So our mission today is really to weave all these different threads together. We want to get beyond just, listing facts.
Yeah, we want to understand the emotional side, the business reality of failure, but also really shine a light on some of those specific tax implications and strategies, things that can make a difference when you're dealing with the aftermath.
What really happens when a venture doesn't succeed? How do these financial systems and the psychological impacts kind of interact?
And most importantly, what are the key lessons you can actually take away from other people's experiences and, from the official guidance that's out there?
Okay, so let's jump right in. Let's start with that hard reality of business failure and that raw, candid story from Reddit. It's about a restaurateur who really put everything on the line. Personal money, time, health.
Everything.
And
And it didn't make it. They described a 140-seat restaurant in LA, and the numbers were stark. Monthly sales dropped dramatically, like from $100,000 down to $45,000 in just the last 3 months of 2023.
wow, that's a steep drop.
Huge. And they were the single owner operator, had about 10 silent partners who'd each put in around $10.
Okay.
One partner invested more, $120,000, and also gave a $100,000 loan. The plan was to repay that loan with an SBA loan, but that never actually came through, which is just
Oh,
frustrating.
man, and the personal sacrifice is just immense. You said the owner didn't take any pay for 3 years.
Zero pay for 3 years. That level of commitment, risking everything,
Yeah.
it really brings the reality of entrepreneurship home, doesn't it?
It absolutely does. And they mentioned reasons for the decline.
Yeah, several things. Weather was a big one. It significantly impacted their beach location. They also lost a popular brunch event because of issues with the city and the organizers, and then just the broader economic climate. They felt it was slowing things down across the whole industry.
It's a tough story, but it's important to hear. And you see echoes of this, maybe on a different scale, in that Acumen Failing Forward report you mentioned.
Right. What's fascinating there is they looked at 167 companies they invested in over 22 years, and a majority, more than half, either didn't achieve the impact they hoped for, weren't financially sustainable, or it was just too soon to tell.
So only about a quarter were considered real successes, home runs, as they called them.
Exactly. Only about a quarter. And that's a crucial insight, I think. It shows that even really sophisticated venture philanthropists investing with patient capital, aiming for both social impact and financial sustainability,
Yeah.
they face incredibly high failure rates.
So it's not just individual entrepreneurs struggling. Navigating uncertainty is just baked into these kinds of ventures.
Absolutely.
Yeah.
Which really underlines why we need to talk about failure, right? The Acumen report is blunt about it. It's uncomfortable. It's painful, sure. But if we don't discuss it openly, analyze it,
Miss the chance to learn.
exactly, we squander the opportunity to learn and actually make progress. And that really resonates with the Reddit user wanting to learn from what they call their massive mistake.
Yeah. And bringing in that Menu Tiger source gives some useful industry context for that specific restaurant situation.
Right. They list common reasons for restaurant failure. Things like a bad location, apparently, that impacts over half of diner choices.
Wow.
Poor operational management, too, like problems with inventory or staffing inefficiency. That can cost a business around 20% of its sales.
That's significant.
Definitely. And weak marketing is another big one. Diners rely heavily on social media, websites. Something like 8 out of 10 check the website before going. And just not adopting technology can make things inefficient, too. So you could see how those pressures might have played into the Reddit story location, operational strain, external factors.
Yeah, you really can. Okay, so moving from the sort of business mechanics to the really personal cost. That Reddit post is stark. The user talks about falling into a deep, dark depression.
Yeah. Feeling like the business was, quote, eating away at their soul, leading to panic attacks, losing time with family, losing sleep.
That's the huge human side of financial struggle that often gets, well, overlooked. And it raises that big question, how does financial stress ripple out? How does it affect us beyond just the numbers?
The helpguide.org source gives us a pretty clear picture here, and it highlights just how common this is. Even before recent economic issues, something like 72% of Americans reported feeling stressed about money.
72%. It's a really pervasive stressor.
It is, and the health effects can be severe. Help Guide points to things like insomnia, sleep problems, resorting to unhealthy coping mechanisms, maybe drinking, overeating, things like that. And in really tragic cases, even self-harm or suicidal thoughts.
It's heavy stuff.
It is. And they describe this vicious cycle. Financial problems make your mental state worse, which then makes it harder to manage your finances.
Yeah.
Maybe you can't focus, you lack motivation.
Which leads to more financial problems.
Exactly. Which damages your mental health further. Breaking that cycle sounds incredibly tough.
Yeah. So what does Help Guide suggest? What are the coping strategies?
Well, a crucial first step, they say, is simply talking to someone, a trusted friend, family member, or ideally, a professional, a counselor or financial advisor.
Even though money can be such a taboo subject, right? Shame and embarrassment often stop people.
Totally. But bottling up that stress just makes it worse. Getting professional help isn't a weakness. It's actually proactively addressing a serious issue.
Okay, talking is step one. What else?
Taking a clear inventory of your finances. And that means tracking everything, all income, all spending, even the small daily stuff.
That sounds daunting.
It can be, initially. But the idea is that this process helps you see the reality of your situation, and maybe counterintuitively, it can give you back a sense of control.
Okay, I see. Get the facts straight.
Right. Then, once you have that clear picture, identify the specific financial challenges and create a plan. Brainstorm solutions. Maybe talk to a nonprofit credit counselor.
And then obviously you have to put the plan into action.
Yeah, and monitor your progress. Importantly, don't get completely derailed by setbacks. Everyone faces unexpected hurdles. The goal is just to get back on track as soon as you can.
Makes sense. Budgeting must be in there too.
Foundational. Create a monthly budget. Cover essentials, bills, and ideally set aside something for annual costs and emergencies. When things are really tight, prioritizing necessities, food, housing, utilities over things like credit cards is often just necessary.
Right, and beyond the direct money stuff.
Managing overall stress is vital for resilience. Help Guide mentions things like regular physical activity, relaxation techniques, meditation, deep breathing, that sort of thing.
Getting enough sleep.
Crucial. And finding ways to boost your self-esteem. Maybe helping others, spending time in nature, connecting with supportive people. All that helps ease the mental and physical burden.
Okay, so that covers coping with the stress. Now let's shift gears a bit. After navigating the emotional side, the business closure, what does all this mean when it comes to the financial and tax implications? This is a critical piece.
Absolutely. And this is where understanding what kind of property we're talking about becomes incredibly important from a tax perspective. The IRS treats different assets very, very differently.
Okay, let's get into that. When the IRS talks about capital assets, what do they mean?
Generally, they mean property you own for personal use like your house, your furniture, your car, or property you own as an investment, stocks, bonds, that kind of thing.
And when you sell those, you report gains or losses on Schedule D and Form 8949, usually.
Typically, yes. But here's the crucial distinction. The IRS explicitly says certain things are not capital assets. And this list is really relevant when you're dealing with a business.
Like what?
Things like inventory, property you hold mainly to sell in your business, accounts receivable from your business, and importantly, depreciable property and real estate used in your trade or business.
Okay, so the restaurant equipment, maybe the building if they owned it for the business, the food inventory, those aren't capital assets like your personal house or stocks are.
Correct. When you sell or get rid of trade or business property like that equipment, or the business real estate, or other non-capital assets related to the business, you generally report it on a different form. Form 4797.
And the rules for gains and losses might be different.
They can be, yeah. It's a different category.
Okay, that distinction matters a lot. Now, what about losses from actual capital assets, say, investment stocks that went down? How are those treated?
For capital losses, you can deduct them, but there are limits. First, you use capital losses to offset any capital gains you have in the same year.
Okay, cancel each other out.
Right. If you still have losses left over after offsetting all your gains, you can then deduct up to $3,000 of those remaining losses against your ordinary income each year.
Only $3,000 against regular income. What if your loss was much bigger?
If it's bigger, you carry the excess loss over to future years. You can use it to offset future capital gains or continue deducting up to $3,000 against ordinary income each year until the loss is used up.
So you can't necessarily deduct a huge investment loss all at once against your salary, just that $3,000 limit plus any gains you had.
Exactly. $1,500 is the limit if you're married filing separately, by the way.
Yeah.
And it's also worth noting, some losses are not deductible at all, even from capital assets.
Like what?
This mainly applies to sales between specific related parties. Selling property to, say, a family member or a company you control just to create a tax loss, the IRS has rules to prevent that kind of thing.
Got it. Okay, now let's dive into some specific situations. These rules can get really specific, can't they? One that might relate to the Reddit user, depending on the details, is the home sale exclusion.
Ah, yes, this is a big one for personal finances. The IRS lets you exclude a pretty significant amount of gain when you sell your main home, up to $250,000 if you're single.
Or $500,000 if you're married filing jointly.
Right. Huge potential benefit. But there are tests.
The key ones being,
You must have owned the home and lived in it as your main home for at least 2 out of the 5 years leading up to the sale date, both ownership and residency tests.
2 out of the last 5 years. Okay. Are there exceptions?
Yeah, there are rules for a reduced exclusion if you have to sell early because of the things like a job change, health reasons, or certain unforeseen circumstances. There are also special provisions for surviving spouses, or if you're on qualified extended military or government duty outside the U.S., they can pause the 5-year clock.
So for the Reddit user who sold their share of a duplex, this exclusion would only apply to their part if that duplex was actually their main home for those 2 years.
Precisely. It has to be your primary residence.
Okay. Another really important rule, especially for investors dealing with stock market losses, the wash sale rule. Both the IRS and Schwab mention this one.
Yeah, this trips people up sometimes. It's designed to stop you from selling a stock at a loss just to get the tax deduction and then immediately buying the same stock right back.
So what are the specifics?
If you sell stock or securities at a loss, and then you buy substantially identical ones within 30 days before the sale or 30 days after the sale, that whole 61-day window.
Then the loss is disallowed? For now, anyway?
Exactly. You can't claim that loss on your current tax return.
So you can't immediately repurchase if you want the tax loss now. What happens to that loss you couldn't claim? Is it just gone?
No, it's not gone forever. It gets added to the cost basis, basically the purchase price for tax purposes of the new stock you bought.
Ah, so it reduces the gain or increases the loss when you eventually sell the replacement shares?
Right. It effectively delays the tax benefit. Understanding what counts as substantially identical is key here. It's not always straightforward.
Complex. Okay. The IRS also mentioned something about a special election for actual traders in securities, people doing it as a business.
Yeah, this is pretty niche. Section 475 FA. If you qualify as a trader, which is a higher bar than just being an active investor, you can elect to use what's called mark-to-market accounting.
And what does that do?
It means your gains and losses from selling securities in that trading business are treated as ordinary income or loss, not capital gains or losses. You'd report it on Form 4797 like other business income loss. It's a totally different tax treatment, but again, very specific to that trader in a business context.
Got it. Now here's something that sounds like a potential bright spot, maybe for investors in certain startups or small companies. The Qualified Small Business Stock Exclusion, QSB stock, Section 1202.
This one can be a huge benefit. If you invest in qualifying small business stock, and this is key, Quest, hold it for more than 5 years before you sell.
Yes.
You might be able to exclude a big chunk of the gain from your income for tax purposes. The percentage you can exclude depends on when you acquired the stock.
How much can be excluded?
It ranges. It was 50% if you got the stock on or before February 17, 2009, then 75% for stock acquired after that but before September 28, 2010, and potentially 100% exclusion if you acquired it after September 27, 2010.
A 100% gain exclusion. That's massive. But I'm guessing there are some pretty strict requirements for the stock to qualify.
Oh, absolutely. Lots of hoops to jump through. It has to be stock in a C corporation. not an S-corp or LLC. It must have been originally issued after August 10th, 1993.
Okay.
The corporation must have had total gross assets of $50 million or less at the time the stock was issued and immediately after. You generally need to have acquired it at its original issue, or maybe through a gift or inheritance from someone who did.
And crucially,
The corporation has to be actively conducting a qualified trade or business during substantially all the time you held the stock.
Okay, qualified business. This connects back to what we discussed earlier, right? Are all businesses qualified for this?
Definitely not. And this is a really important point. The IRS lists specific types of businesses that do not qualify. That list includes things like banking, farming, hotels, and notably restaurants.
So even if you invested in a small restaurant, held the stock for over 5 years, and it met the asset test, it still wouldn't qualify for the QSB exclusion because a restaurant isn't a qualified business for this purpose.
Correct. Unfortunately, for someone in that situation, no Section 1202 exclusion. It really highlights how specific these rules are and how much the type of business matters for certain tax breaks.
That's a really key distinction to understand. Wow. The IRS source also mentions a couple of other, maybe more niche exclusions?
Yeah, briefly. Things like the DC Zone Business Asset Exclusion or the Qualified Community Asset Exclusion. These apply in very specific geographic areas or to certain types of assets, each with their own set of rules.
Okay.
And there's also the option to defer certain capital gains by investing them into a Qualified Opportunity Fund, or QOF. You might even be able to exclude future gain on that QOF investment itself if you hold it long enough, like 10 years.
So lots of specialized provisions out there depending on the specifics.
Definitely shows the complexity of the tax code.
Okay, finally, let's loop back to a proactive strategy that Charles Schwab mentioned, specifically related to investment losses, tax loss harvesting.
Right, this is a tactic investors can use intentionally, not just reactively dealing with a loss. It involves deliberately selling investments that have gone down in value.
To generate capital losses strategically.
Exactly. The goal is to use those losses to offset capital gains you might have realized elsewhere in your portfolio.
Or to deduct against your ordinary income up to that $3,000 annual limit we talked about.
Precisely. And any excess losses beyond that can be carried forward to future years. It's mainly useful in taxable investment accounts, doesn't really apply in retirement accounts like IRAs or 401ks, where you don't pay taxes on gains and losses year to year anyway.
And you absolutely have to be careful about the wash sale rule we discussed earlier when doing this, right? Can't sell for the loss and buy it right back.
Absolutely critical. You need to avoid buying a substantially identical security within that 61-day window. Schwab points out that if you do this consistently, tax loss harvesting can potentially improve your overall after-tax investment returns by actively managing the tax hit on your gains.
Makes sense. Okay, let's circle back one more time to the business world, specifically restaurants, but drawing lessons that could apply more broadly. The sources give us insights from the investor's point of view, too.
Yes, the Aaron Allen and Associates source talks about restaurant due diligence. This is that thorough investigation process that potential buyers or investors go through before putting significant money into a restaurant business.
It's about understanding the real risks, checking the forecasts, figuring out the true value.
Exactly. It goes way beyond just glancing at the profit and loss statement. They do commercial checks, operational checks, financial, legal, even technology assessments.
What does operational due diligence involve?
Oh, diving deep. Analyzing key performance indicators, KPIs, metrics like sales per square foot, table turn times, and comparing them to industry benchmarks. Scrutinizing food costs, labor costs, checking service standards, looking at the supply chain, facility maintenance.
Even looking for bottlenecks in the kitchen or service?
Yeah, operational flow. And financial due diligence means really digging into years of financial statements, not just taking them at face value.
And that source highlights common issues that industry experts often find, things that maybe general investors might miss.
Right. Things like poor industrial engineering, basically, and an inefficient restaurant layout, or underestimating the technology needed to actually grow, like needing better back office systems or maybe an ERP system, or just not having strong documented processes for things like staff training or operations.
And fixing those underlying issues requires investment, CapEx.
Yeah, spending capital expenditure, money on long-term assets or improvements. But fixing those fundamental weaknesses is often seen as a way to significantly boost the company's value because it improves efficiency and capability.
So why is this relevant to you, the listener? I guess understanding what makes a business fundamentally strong or weak from this expert investor angle gives insight into why businesses fail that goes beyond just blaming the economy or bad luck.
Exactly. The Reddit user mentioned building issues, employee problems. Those are precisely the kinds of operational and facility weaknesses that proper due diligence would flag as internal risks.
It shows that strong internal operations are just as critical as dealing with external pressures.
For sure. And the menu tugger source actually gives some practical strategies for trying to save a failing restaurant, which also serve as lessons learned.
Like what?
Conducting a really comprehensive financial assessment to find hidden costs or unprofitable menu items, doing a customer experience audit, optimizing the menu based on profitability and popularity, using targeted marketing, reviewing and improving operational efficiency.
Actively getting customer feedback.
Yes, and analyzing it. And integrating technology. They specifically mentioned using QR code menus as a simple tech integration that can improve order accuracy, speed things up, meet customer demand for contactless options, and potentially even boost sales.
So concrete steps that address those operational and strategic things investors look at?
Right. Things that might help turn things around or at least provide valuable lessons for the next venture.
Okay, so wrapping this all up, what does this all mean? We've really taken a deep dive here into the difficult reality of business failure, from that deeply personal story to the broader trends investors see.
We've explored the significant emotional, even physical toll financial stress can take, and looked at concrete strategies for coping with that stress.
And we navigated some pretty specific, sometimes complex, tax rules, capital assets versus business property, how losses are treated, things like the home sale exclusion, the QSB stock rules, and importantly, why QSB might not apply to certain businesses like restaurants.
Plus strategies like tax loss harvesting. It's clear that failure, while incredibly painful, is a common part of the entrepreneurial and investment journey. Seems the key is acknowledging it, understanding the reasons why, both internal and external.
And learning from it, operationally and financially. That seems crucial for moving forward.
Absolutely. And understanding these details really matters, doesn't it? Knowing how the IRS defines different assets, the tests for the home sale gain exclusion, the wash sale rules impact, realizing a potential tax break like QSB might not fit your situation. Having this knowledge is critical.
It also means recognizing when you need help, right? Leveraging available resources, whether it's IRS publications, financial counseling, or professional industry expertise.
Definitely. Knowing where to look or who to ask.
So here's a final provocative thought for you, the listener, to mull over. If really understanding why businesses fail and navigating the complex financial aftermath and tax rules requires such deep dives, such expert guidance, how can individuals best prepare themselves both mentally and financially for the inherent risks that come with business and investing in today's constantly changing economic landscape?
It certainly underscores the value of continuous learning, staying informed, but also knowing when to seek out qualified professional advice that's tailored specifically to your situation. Exploring resources like IRS Publication 550 on capital gains and losses is a good start, but talking to a trusted tax advisor or financial planner might just be the most valuable step you can take.